In today's class, let us try to understand the organization of money market. Now, we all know by now that money market is a systematic arrangement for provision of short-term funds. The short-term funds are supplied by lenders and demanded by borrowers. The money market in India is broadly classified into organized and unorganized sector. The organized sector consists of the banking and the non-banking financial institutions, such as the Reserve Bank of India and the 12 nationalized banks, which include State Bank of India. In 2020, we saw the merger of nationalized banks in India, which led to 7 large public sector banks and 5 smaller ones. Prior to that, we had around 21 nationalized banks. The organized sector also includes scheduled and non-scheduled commercial banks, foreign exchange banks, which mainly finances international trade, and RRBs, that is regional rural banks. The banking financial institutions in organized market are regulated by Reserve Bank of India. Non-banking financial institutions of money market include Life Insurance Corporation, General Insurance Corporations and its subsidiaries, along with Unit Trust of India. Other special institutions such as Industrial Development Bank of India, State Finance Corporation, National Bank for Agriculture and Rural Development, Export Import Bank, etc., which operate in the money market indirectly through the banks, and quasi-government bodies and large companies also make their short-term surplus funds available in the organized market through banks. The unorganized sector consists of indigenous banks, money lenders, pawnbrokers, chit fund companies, traders, relatives, and friends. We have studied this in detail when we were looking at the components of or the organization of financial sector in chapter 2. This sector is not regulated by RBI or any other institute. All the components of the unorganized sector operate independent of each other. Cooperative credit societies lie in between organized and unorganized part of money market. The three-tier structure of cooperative credit societies have state cooperative societies at the top, that is state level, state or district cooperative societies at the level of district, and the PACs, that is primary agriculture credit societies at village level, and urban cooperative banks in cities or towns. Okay, having understood the organization of money market, which is broadly classified into organized and unorganized sector, let us have a look at the sub-market of organized money market. And when we come to the instruments of money market, you all will realize that each of this sub-market has its unique financial instrument which gets traded here. The first sub-market of money market is call money market. The most important component of organized money market is the call money market. It refers to market for extremely short period borrowings. Call money market deals with day-to-day surpluses and deficits in money market. It tries to bring about an equilibrium between surpluses and deficits in money market. The loan in call money market varies from 1 day to 14 days. The loan granted for 1 day is known as call money. If the fund is lent for a period between 1 day to 14 days, then it is referred to as notice money. Loans for more than 15 days in interbank market are known as term money. Call money loans are not backed by any securities. The major call markets in India are situated in Mumbai, Kolkata, Delhi, Chennai, Ahmedabad and Bengaluru. Call money loans are usually availed by brokers and dealers in stock exchange markets and banks. In India, the commercial banks are the biggest participant, hence The call money market is also known as interbank call money market. This is what we had referred to when we were speaking about the functions of money market, in which I had explained one point as it helps to strengthen the commercial bank. This is what it was, okay, interbank call money market. The bank with temporary shortage of funds borrows from the bank with temporary excess of funds. The next sub-market is treasury bill market. The sub-market where government securities are traded is known as treasury bill market. The central government can raise funds with the help of treasury bills or government bonds. Treasury bills are issued to raise short-term funds while government bonds are issued to raise long-term funds. The maturity period of treasury bills issued at present is 91 days, 182 days and 364 days. The treasury bills are auctioned by RBI on behalf of central government. The treasury bill market in India is underdeveloped as compared to treasury bill market in USA and in UK. Hence, treasury bills in India are usually held by commercial bank, state government, semi-government bodies and are not so popular among non-banking financial institutions, corporations and individuals. The third sub-market is commercial bill market. Commercial bill market deals with the commercial bills issued by business firms and corporations. It is a credit instrument which facilitates domestic and international trade. Commercial bills are generally of 3 months maturity. Commercial bills can be discounted and rediscounted. India does not have well-developed acceptance and discount houses, and hence the role of discounting bill of exchange in India is largely performed by commercial banks. Okay, next is collateral loan market. This market provides short-term loans backed by securities. The collateral securities may be in the form of government bonds, stocks, and shares. The collaterals provided are marketable and usually does not fluctuate in prices. The collateral is returned to the borrower once the loan is repaid or is traded in the market if the borrower defaults. The commercial banks in India provide collateral loans to private individuals or companies. The fifth submarket is certificate of deposit and commercial paper market. It refers to a market where commercial papers and certificates of deposits are traded. Reserve Bank of India has introduced these two instruments in March 1989 to widen the scope of money market instruments and provide greater flexibility to the investors for investing their short-term surplus funds. Acceptance market is the last one. The sub-market of money market, which deals with bankers' acceptance, is referred to as acceptance market. Bankers' acceptance is a draft drawn by a non-financial institution upon a bank and accepted by it. Bankers' acceptance are quite safe money market instruments and are hence mostly used in foreign trade transactions.